Hello everybody, welcome in. This is going to be a super exciting one. Today I'm going to talk about call options. Huge demand for you all to know more about call options and basic call strategies. And not only am I going to explain how call options work, but also show 11 real life examples from the Patreon community, things that they've done. I did a little survey with the Patreon capitalists last night and asked for them to share their option positions with me. And I went and analyzed over 100, picked 11, and I'm going to show you the results from the bake-off. And I think that's the best way to learn, to see real live cases so I can identify what's good and what's bad and what's ugly in every single trade. So without further ado, in math we trust. Again, a lot of math in this one, but it's fun. And I have a new model as well to share. Disclaimer, none of this is investment advice. What is a call option? We've gone through this definition before. They are contracts that give the buyer the right but not the obligation to buy a stock, bond, commodity, or other asset. Now, obviously, when you buy a call option, you're looking for the underlying asset to increase in price. The reason I'm so fascinated by call options and options in general is because you get a lot of leverage. You can move a lot more with a lot less and get a lot more return for your money. So for example, if the stock is $1,000, you can buy a call option for a lot less and not have to put all that money down. So I'll show you those examples as well as we go deeper. Call option. Okay, now an easy way to explain how this all works. Imagine John and Sarah. John owns a house. He fears the economy is going to tank, but he wants the option to sell his house at a point in time in the future, 6 months from now, because he needs somewhere to live for the next 6 months. And he cuts a deal with Sarah. She wants to have a house as well, but she doesn't have any money today because she has it all tied up in Bitcoin. So it's working out for both of them perfectly. Again, John needs a place to live for 6 months, feels the economy is going to tank, therefore he wants to lock in the $500,000 price on the house. Sarah wants the house. Doesn't have the cash right now because she wants to get the returns on Bitcoin first and then sell some Bitcoin to buy the house in 6 months' time. That's the plan. Now, in order to secure that deal, Sarah needs to pay John $10,000 to guarantee the price of $500,000. Now, the house could go up in value. Real estate has appreciated over 10% in the last month or so in many zip codes in the United States. So it could be worth $550,000. But he is guaranteeing that she only has to pay $500,000. Now the price could also go to $450,000. That means Sarah would be losing. So that's basically how a call option works. Very, very simple. Now to give you an idea of how it all works on a line, obviously you have your break-even point, your strike price, and the premium. So in this house example, the house is the $500,000 asset. The strike price is $500,000. The premium is $10,000. And that's how it works. If the price goes above $510,000, that's the profit line of Sarah on actually buying the house. If it goes below $510,000, she's losing money. So I explained it all very clear, but when we go into the 11 case studies, it should be a lot simpler. Now, when you trade options, you need three things. You need knowledge, you need margin, and you need options authority. So make sure you have that. But before you do any of that as well, make sure you paper trade, you practice before you execute with real money. Again, this is very tricky. One little mistake and you can lose everything. So again, what I would like from everybody is to practice and find a way of winning 9 times out of 10 before you start playing with real money, because this is very dangerous. And remember, 90% of options actually lose money. So be careful of that. You don't want to be in that 90%. You want to be in the 10%. And that's what my job is, to help you do that. Now, volatility is another interesting element. The higher the volatility, which is a fluctuation of a stock price, the higher the price of the option. The lower the volatility, the lower the option. So you don't really want to buy options after a very volatile time within an equity or an asset. So it's very important to remember. But it's a good time to sell those ones when it's very high volatility. And of course, I like asymmetric bets. I like the odds on my side, and the way I do that, and just a reminder to everybody, my approach to investing is risk management using financial tools, technical analysis, hedging, and arbitrage. I do a lot of research, both macro and micro, and quant. a lot of numbers you need to analyze, like Black-Scholes options pricing models, practice with paper trading, etc. Know your exit before you enter. All of these different types of rules. If you can nail the three categories, the three-legged stool, then you're going to be in good shape and you will increase the odds of making profit in this business. So, quick thank you to the Patreon community that submitted all their option trades that I analyzed. There's a lot of very complex trades and structures, as well as very simple ones. I just chose simple ones from different people to be able to illustrate the cases that we have today. So without further ado, my favorite way to learn is by real examples that we can all relate to. There's no point in talking in esoteric terms, but when you can show real ways and real deals and real trades and point out where they're good, where they're bad, it's the best way to learn. So that's what we're going to do today. So from the over 100 submissions from Patreon, I reviewed most, analyzed the ones that were similar to compare and contrast. And let's jump in and see what we got. So this is a new spreadsheet that I built, and I'm going to make it available to Patreon capitalists so you guys can actually manage your own option spreadsheet. This will save you a fortune because it'll give you the rigor and discipline and the ratios to look at when you actually trade options. These are the 11 deals that I looked at with the expiration dates. They're all call options. They're all purchased. I have the strike price. I have the premium paid. I assumed one contract for every trade. DTE is days to expiration. Then you have the stock price today. This spreadsheet also automatically populates the stocks. You just punch in the ticker on the left and the break-even price. The delta from the break-even price and the option premium. The option premium to the actual price of the stock ratio, which is very important. And I'll talk about that as well. These two things, just to highlight them again, the delta from break-even point, this is how far you are away, how far the stock needs to move before you'd even get to break-even point with an option. And people sometimes, they go into option trades without even looking at this. And you can see anytime it's like 35% or above, it's scary. So anything there you see orange or red, it's not a good sign. The second ratio I like to look at is the option premium to the stock price ratio. This should never be above 35%. And you can see a lot of them are. So already we have a couple of little issues with some of the trades that people are doing, but that's what this is about. This is to fix it all. So first one is Amazon. Okay, this is from George. The expiration date is June 21. It's a call. The strike price is $3,500. Premium he paid is $194. The days to expiration is 102. And the current stock price is $3,100. And the break even is $36.94. And the delta to break even point is 18.64%. So the stock needs to move quite a bit just to get to break even. And the option premium ratio is good, very low at 5.5%. So the good in this particular case is it's Amazon, and Amazon's a solid company. The bad, though, is the strike is out of the money, and the time is short. Basically, we only have until June. I always recommend people buy at least a year of time. I know it's more expensive, but it's also a lot safer. And then the ugly is the break-even point is $36.94, and the Amazon all-time high is only $3,552. Quick look at the chart here. This one has me worried because we have a long hill to climb to get up above $3,600 to make this trade work. So bad news there is that one would make me very nervous. So hope that was clear. But let's look at some more cases. This is GLXY Digital. Again, GLXY price today is $18.11. Strike price on this option is $16, which is good. The premium paid was $6.26. The break even is $22. The delta from break even is 23%, so the stock needs to move 23% to make this trade work. And the option to premium ratio is high. So the good in this case is, yes, you bought time because you have until December this year, so lots of window to make things happen. And I believe there's great Bitcoin upside for GLXY. So they're the two big positives. So yes, big thumbs up there. The premium, though, is very, very high. The option premium to the price of the stock is 40%, and that is too rich for my blood. And the all-time high is the break-even point. So a couple of things that give me a little bit of concern, but let's have a look at the chart real quick. So the question is, can we make it? Can we make it to the little cocktail glass up there around 22? And I think we definitely can by December. So again, not a perfectly structured option, but it'll work. Pretty confident. Okay, MicroStrategy. This is very interesting. This is the gift that keeps on giving. I love MicroStrategy, and sometimes I'm afraid someone's going to knock on my door saying, "You're making too much money on MicroStrategy," but it's just awesome. Anyway, 2 big trades. Again, I think a lot of people have been watching what I've been doing with MicroStrategy. And I went in recently when it hit 540, nailed the bottom, and it's paid off very nicely. And it's just gone over $800 today. So from 540 to $804 in less than a week. It's fantastic. Anyhow, here we are. We've got Kenny and we've got George. So Kenny bought the leaps going out to 2023, which is awesome. Buying time is great. Strike price is great at 600, premium 271. So he's got like 680 days to make this trade happen, make it work. And the current stock price is 803. His break even is 871. And he's only 8% away from making this trade work. In fact, he's probably already in profit because he has so much time value in his option. Now, George, on the other hand, he has until January 2022, which is also good. His strike price is 750, premium 278. He's got 316 days to go, and his break even is 1,028. So he's got a little bit more of a hill to climb, but both of these trades would work. So the good for Kenny is he got time and he great in the money strike. The bad for Kenny is the option to price of the stock ratio of 45%. So this is not good. So I think the premium was too high. When he probably got in around 540, 560, he paid way too much premium because the stock was so volatile. Now you would have been better off in that case just to buy the stock on margin, safer, better, longer term returns. But anyway, it'll still work. And then in terms of George, the good is time. The bad is it was probably an out of the money strike when he bought it, I reckon. And the break-even point is very high, over 1,000. So all in all, both of these trades will probably be profitable. I'm pretty convinced because I know the stock very well. And to illustrate that, the rocket is where we did the trade on Patreon last. Kenny, that's your break-even point with the cocktail glass. And George, your break-even point is a little higher, therefore the glass is tipping over a little bit. But yes, you'll both make it, and good job, and buying time and being in the money and everything else. All right, NIO. This is a cheap imitation of Tesla. I'm not a NIO fan, but again, this is a trade. Now the good for this, so NIO is currently trading at $46. The strike price is $46, premium is $12.45. And his break-even price is $58. The delta from the break-even price is 27%, and the option to price ratio is 27%. So the good, it's an in-the-money strike. The expiration, though, is August, and I hate August because August is like the doldrums. So you never know what the market will do. Normally, historically, the market always falls flat in August. And something is very uncanny here where a lot of you are buying August. And also the ugly is the 1-year target for NIO is $57. Your break-even price is $58. So that one gives me a little bit of pause. I don't really analyze NIO, but I'd be careful there. Make sure if you do have your break-even point, which you'll get from the sheet that I'll share, make sure that you can make it work. I don't want you putting structures together that are outside of the 1-year analyst target. Quick look at the chart. It's an ugly chart. This basically, the stock needs to go up 27% to get to break even. It can do it because it's an EV maker, but I don't know. Maybe there would have been better ones. So Invitae, another great one that I am actually in as well. So we have Dio and Pole 1 and Pole 2, all different plays, all call options, different strikes, 60, 35, and 55. Premiums of 5, 15, and 5. And here you see the current stock prices did 43. It's bounced very nicely from the mini crash that the whole industry faced. And the break-even price is 65, 51, and 60. The delta for break-even is 52, 18, and 31. So basically, net real quick, Dio has a good option to price ratio, but the time is short and is way out of the money strike, which I don't like. Paul has an in the money strike, which is good, but the time is short, which is bad. And Paul number 2, the out of the money strike and time is bad, and the delta from the break-even point is really ugly. So that would be Invitae, not perfect. This is the quick chart now on Invitae. So basically here, I do see us getting to 58 by June. Not a problem there. So these trades could work. And as I said, I see Invitae being a $60 stock over the next couple of months pretty easily. It's a red hot and it could go way beyond that. So not a lot of concern there. Palantir, next trade. So Palantir, this one is interesting. And I was looking at this myself. In the recent dip, I was waiting for it just to go down to the very low 20s. I didn't get a fill. The strike price 25, premium 750. And you can see here the break-even price is 33 and the delta from break-even is $21. So the good is it's in the money, but the bad is the expiration is August. And as you know, I hate August. Let's look at the chart real quick. Having 33 by August should definitely be achievable, so that could happen, but there was probably better ways to structure that particular option. Tesla, my favorite, of course, after MicroStrategy. Here we have Ryan and George, their bake-off. You can see here, $800 strike and a $550 strike. If you look at the premium paid by George and the option price to the actual stock price premium of 64%, that is crazy high. So the good for Ryan is that he got time and the good ratio. The bad is the break-even point is high, above the all-time high of Tesla. George has an in-the-money strike, that's good. The break-even point is high, above the all-time high as well, and shorter time. And the option to the stock price ratio is nuts. He paid way too more. That's a case where you should have just bought the actual stock itself. Let's look at the chart. Here, I am concerned that we will not be above 900 by the end of this year. We could, but I'm not sure. It's a big speculation. So quickly, conclusions for everybody. The lessons today. There's some good from everybody in their trades, some bad, some ugly rule violations, and some people really roll the dice, which is not good. Conclusion number 2 is don't go cheap. Buy time and be in the money. Always be in the money and buy time. Remember that, everybody. 2 most important things. So if you want to learn more about getting better as an investor, please join the IA community. If you want to go deep into models and everything else, join the Capitalists. It's probably the best $10 a month you'll ever spend. And one person said to me, they made one trade that we recommended and it paid for Patreon for the next 37 years. So hopefully we're all around in 37 years to enjoy that as well. So if you want more, hit the like, subscribe. Thanks all. Watch for the scammers. Be safe, everybody.